Hi there, it's Ken Majmudar again for another video on one of our topics for investing with Ken. What I want to talk about today is how evolution actually makes most people bad at investing. So it's a really broad, interesting topic. Actually, I just got into learning about something called evolutionary psychology, and it's actually a relatively new field. So what this is the intersection between what we know to be our psychology, but how that psychology is based on very strong forces that helped us evolve and adapt to the environment in which these psychological forces came to be. And the way I got into this was I started reading a book by a guy named David Buss, B-U-S-S, called Evolutionary Psychology. The book's a little bit dense, but it's amazing, and it has a lot of great insights in there about this field of evolutionary psychology. The field is actually relatively new, so it hasn't been even fully accepted as a field, but it's a multidisciplinary field that's combining insights from all different areas, obviously biology and evolution, and also psychology, chemistry, some other fields. I found it super fascinating. And the other thing that I've also read a bunch of other articles, probably the best article that I found on this is from Harvard Business Review, because they wrote a great article called How Hardwired is Human Behavior. And that, I think, gives you a clue about sort of the importance of this field, because a lot of our behaviors are hardwired, which is related to how we evolved in the world that we were in when we were evolving these different traits. Just as a background, to catch everybody up, most people have heard of Charles Darwin. He wrote an incredibly important book, around 200 years ago, almost, about the origin of the species. And he went on this huge voyage all over the world collecting samples. And he was sort of the first one that explained that natural forces, help all life evolve, and that all life seems to be connected in a particular way. And most people know about natural selection, which is the main force within evolution. The idea is that, genes determine what we are like physically as well as mentally, and genes have to be passed on. So actually what most people know about natural selection, that is that if you're adapted to the environment, then your genes pass on, so they become more and more prevalent in the gene pool. But Darwin actually talked about two types of natural selection. So the first type was based on survival, so traits that helped us survive. But there was a second type, which I actually didn't know about or never really focused on until I actually read about evolutionary psychology, which is sexual selection. So the idea is that traits that help you survive are passed on, but also traits that make you more attractive to the opposite sex, and therefore you get chosen, therefore helping you to pass on your traits, are also help you in terms of natural selection. So there's these two types of natural selection going on. One based on survival-based selection, and then the other based on sexual selection, that is making you more attractive to be a mate. So obviously these factors helped our bodies evolve, but our minds are simply part of our bodies. And so our minds also evolved in ways that helped us to pass on our traits or to be more attractive to the opposite sex. And that was a really interesting insight. So where is the intersection between that and investing? Investing is a relatively new idea, right? It just came up over the last, say 5,000 years in terms of, or 10,000, whatever, tens of thousands of years. Whereas our psychology evolved over millions of years. In fact, some of our psychological traits evolved in predecessor species and were just simply passed down. Other psychological traits are unique to Homo sapiens, to human beings, and those evolved, say, several 100,000 years ago um, on the savannas of Africa. And at that time, it was a very marginal existence. So anything that would give somebody an advantage, whether it be a psychological trait or a physical trait, to survive and to be selected as a mate would actually be passed on, would become more and more prevalent in the gene pool. So that's sort of how a lot of the things that our minds evolved to either help us be more attractive or to help us survive are still the forces that we have to deal with today due to evolution. But in the modern world, a lot of the traits that were there for survival in a subsistence kind of plane where there was dangers all over the place and there really wasn't a very limited amount of resources. Today, in the modern world, with modern society and modern systems, etc., the problems and the environment is very, very different. And yet, because we're dominated by these forces that evolved in a very different environment, it's really that makes us so bad at investing. So let me talk specifically about investing versus these traits that we evolve to. And this explains why so many people have such trouble with their investments. They make a lot of bad decisions. They cannot stick to long-term investing, et cetera, et cetera. And so it's all explained by this intersection between evolution, psychology, and uh, making bad decisions using some of these shortcuts that evolution has pre-programmed into us. And by the way, this field of evolutionary psychology is sort of pretty related to another field that's not itself that old, which is behavioral finance. So, 50, 75 years ago, economists pretty much would say we're rational actors. And then behavioral finance came up, and one by one, just through the behavioral side, just saying, doing tests of like, how do people behave? And you find all of these things that are irrational, um, you know, uh, which you can look up and look up behavioral finance. And you'll see there's a laundry list of 15 or 20 things, major things that the researchers found were, hey, we're not really rational actors, and so they made a catalog of all these things and ways we behave. And so they clearly recognized that in finance, all of these suboptimal decisions are actually affecting people's financial health and financial success. So that's where behavioral finance came in. But actually, what behavioral finance is just observe that these behaviors are there, and they're kind of irrational given how finance works. So hey, just be aware of them. It doesn't really make a lot of sense, but this is just the way people are. Evolutionary psychology actually goes even further because it actually shows how, connecting all the dots, that the problems that you observe in behavioral finance that make people really bad at making complex decisions in the modern world, including investment decisions, actually came about for very good reasons due to evolution, due to basically the forces of evolution wanting to or needing to help us survive in the environment that we found ourselves in. And the problem is that those evolved traits don't change that quickly. It takes probably hundreds of thousands of years to continue to evolve to be more well adapted for the modern world. So in the mind column, which some of these things are within behavioral finance, evolution had us programmed in certain ways. And here's a list of some of those things that I got from the HBR article and the book. So first of all, we're pretty much emotional creatures, and we're programmed to follow our emotions. Emotions are very strong there. And the reason that this was great for how we evolved is that we have to make split second quick decisions. And so our evolution helped us to have really strong emotional feelings where we don't have to think about lots of things. We just feel emotions in reaction to our environment, and instinctually we make decisions. Similarly, we didn't really have that much. Food was scarce. All kinds of things were scarce. So we have a very strong inbuilt programming to avoid losses and to really feel losses very strongly. So again, the behavioral finance people call this loss aversion. Other areas that impact on investing in the tribe, this is probably more on the sexual selection side, but those who are confident were attracted and would get status, and status gives them gain. So basically, being confident about things rather than being realistic ended up being a trait. We tend to feel very confident about things, even when we have no business really feeling confident. Another trait that evolved, all these things make sense in the context of evolution, 200,000 years ago on the plains, is we are basically very good, our minds are very good at classifying things, saying, oh, I know what that is. That's another one of those that I've already seen. So that's called classification before calculus. We're not programmed to be very calculating and consider all the angles and basically try to make the best rational decision. Rather, as much as possible, we try to instinctually say, oh, I've seen this pattern before, so therefore I know where this is going, and then make decisions. And all of that, again, from an evolution perspective, was to help us be able to make quick decisions. If we're on the plains and we see something like yellow and black stripes, hey, we don't want to sit there and think a lot about, is it really a tiger? Is it really coming after me? Am I in danger? Blah, blah, blah. We just classify, oh, danger, boom, we run. And another factor which kind of tangentially affects investing is gossip. So in societies, being social, we are social creatures. Studies have shown that time and time again. The ability to gossip, the ability to sort of exchange information casually that may or may not be fully accurate, and make decisions based on that, and try, sort of be able to adjust to changing environments. All of that, we're very much evolved with all of these traits. However, when you apply the fact that these are what our minds are evolved to, as explained by evolutionary psychology, then you compare it to the things you need to be a successful investor, you actually find that investing requires almost the opposite. So, for example, investing is a long-term game. You should be pretty calculating. You should do your research. You should not act as if you know things that you don't know. You shouldn't base your decisions on gossip. So all of these things that we're programmed to do actually hurt us quite a bit in investing. And a perfect example of that is that a lot of investors have a lot of trouble with controlling their emotions, right? So and that puts multiple of these traits into play. So, the market fluctuates all the time. The market is this this entity where people are trading and tracking prices. This is a relatively modern thing. When I say relatively modern, markets have been around for thousands of years, but not probably 100,000 years for the most part. So markets as they exist today, they have a lot of differing information involved. It's very complicated. It's not so simple. And so when people look at their investments and they're getting constant feedback, and so let's say, especially during a market crash or market panic, they see value being lost. Now you've got a bunch of different things coming in play. So emotions before reason. So you feel incredibly strong emotions. Your instinct run away. You have to get out in order to survive. Then loss aversion. What you have, you don't want to lose. And even though it's temporary, the markets fluctuate all the time. So there's a lot of temporary fluctuations. When you see it, it feels like a real thing that you've lost. And so you have loss aversion. You feel a lot of pain. People feel confident in making, what are essentially gambles without doing the calculations, because they classify things. Oh, I know what this is. I've seen this before. And they make decisions on a split second. Again, that's how our brains are evolved. And the gossip, oh, such and such thinks that this is good, and gossip drives investment decisions. So for all of these reasons, because evolution has actually helped our minds evolve these tendencies over time, these same exact tendencies which helped us survive, 100,000, 200,000 years ago in very different circumstances, actually completely undermine us when it comes to making good, rational, long-term investment decisions. And in fact, like when the market goes down or when certain investments go down, number one, we need to be calculating. And so really look at why has it gone down? Is that a permanent thing? Is that a temporary thing? Not make split-second decisions, but make very considered longer-term decisions. Also, suppress the fear, the loss instinct, and instead of classifying things overly simplistically, be very calculating. But these are all things that are, first of all, since the emotions are so strong and so natural, it would be very rare to find people that are aware of it like you guys are now, and then have the training and the maturity to sort of suppress these natural instincts and instead replace them with other things that are actually much more helpful to being successful in investing. So this is the reason why, in my main job as an investment advisor at Ridgewood Investments, it's these factors that help, among many others, where most people, probably upwards of 80%, they should not be doing investing themselves. They should probably outsource it. But recognize that even when you outsource it, there's many people, many advisors who fall into the same traps. And so it's really, really important, but actually quite challenging to find someone or some people that you can trust who have learned and have honed their ability to not base all of these decisions, these complex modern decisions, on the emotions and the patterns that we've evolved hundreds of thousands of years ago in a very different circumstance, but rather to work and hone doing the opposite of these things. And for example, as everybody knows, you're supposed to buy low and sell high. Now, when can you buy low? Normally when things are unpopular. In fact, the best opportunities to buy are often when other people are most scared. One of the famous investing sayings is to buy on, to buy when everyone is very fearful. But that's easy to say. It's very hard to do in practice, and yet it's critical to do that in practice. And this is where having the right advisors, touching on another theme that we did in one of our other videos about Solomon's paradox, why it's so critical to have other people who can work on these things, who have worked on these things, and help to protect you from your own instincts is really the game. So I hope this was a great. I hope you enjoyed the content. I hope that it was helpful in some way. If you liked the content, please hit the like button. Please also subscribe to our channel, as we're going to be putting out lots of other great content on a relatively regular basis. And if you like the topic and you want to read more, I think the best sort of return on the money is to read that Harvard Business Review article. It's called How Hardwired is Human Behavior. We'll include a link to it below this video. It's a great article. There's a lot more actually in it. That article, being it's in the Business Review, is not, it's touching on the things I mentioned, but also quite a few other items that are all from evolutionary psychology and in the context of business, which is a broader context. So it touches also on the management implications of these things, or implications of these things well beyond just investing. But certainly the investment implications alone are tremendous. And even if you can apply a few of these or find an advisor who does, you can really avoid a lot of mistakes and actually position yourself to do far, far better than you otherwise might. Thanks.